Hello, everybody. My name is Jennifer Castenson, and I'm the Vice President of Ambassador and Industry Partner Programs at BuildExact. And we are thrilled to have as a guest speaker today, Robert Dietz, who's the Chief Economist for the National Association of Home Builders. He's been there for 16 years, started out in the tax world, and is now has been the Chief Economist for 6 years. And I don't know who else out there has twins, but Rob has twins at home, and he's trying to, they're turning 13, they just turned 13, and he's trying to manage Christmas presents that make them feel individual and unique. So anybody who has twins can send ideas through chat or the Q&A for him. But like I said, Rob is going to help us understand what's ahead for us in 2022. And how you guys can prepare as the builders and dealers running this the country's housing market. So, Rob, I'm going to pass it over to you. Thanks for being here.
Yeah, thank you. It's good to be able to join all of you today. And thank you, Jennifer, one of the true thought leaders, I think, in our industry. If you don't follow her on social media, please do so. She's always got sort of the latest and greatest of what people are publishing, plus her own commentary. I've read it in Forbes and other places. Yeah, my name is Robert Dietz. I'm the Chief Economist at the National Association of Home Builders. I would guess that many of you are members of your local building industry association or HBA, but if you're not familiar with NAHB, we're the National Trade Association with about 100,000 members representing single-family builders, multifamily developers, and remodelers and land developers as well. And I lead a team of about 10 economists. About half of us have PhDs, and we follow the residential construction industry from a survey perspective, a housing policy perspective. We're based here in Washington, D.C. And then we do a fair amount of data analysis and forecasting. So the outlook I'm going to walk you through today, probably about 35 minutes, looking at some of the macro factors, some demographics, of course, the supply side challenges that the industry has really faced over the last 18 months, but in truth has been supply side constrained for the last 5 or 6 years. And then we'll end with some of NAHB's forecasts. And as Jennifer mentioned, happy to take your questions, and you can enter those into the chat box. So I'm going to go ahead and share my screen. It looks like everything's looking good. So yeah, the title of this presentation, Housing Affordability Headwinds Increase. And I think that is going to be the challenge in 2022. It's worth noting, as we kind of walk through the slides, I'm a little more conservative when it comes to the forecast for the next year or two. You'll see that through my commentary, but it's worth keeping in mind that I think our view is a little more negative than others. And hopefully with some of the data I'm going to present you, I'll give you the reasons for that particular outlook. So let's start with our kind of headline findings. Think of this as kind of our first principles or kind of benchmark findings. Obviously, the virus has dictated both policy and the economy over the last 2 years. We do believe the vaccine combined with natural immunity are supporting economic growth. It does look like the Delta wave is eased, but of course the wild card right now is the Omicron variant. I think it's kind of an outstanding question right now of is this a more contagious version of the virus, one that produces maybe less severe impacts? If that's the case, it could actually be good news and maybe a final wave, or is this something that's going to put real pressure on the public health system this winter in ways that we saw last winter? And I don't think the data is clear yet, but that's certainly something to keep in mind, not just for the economic outlook, but thinking about monetary policy and interest rates. In terms of the macro environment, we think the economy will continue to grow over the next 2 years, but that growth rates are going to slow down and interest rates are going to move higher. And the thing to kind of keep in mind is that today we're going to get additional word from the Federal Reserve on their outlook for monetary policy. And I think most economists, including myself, think that they are beginning to recognize that inflation was not a transitory challenge, at least transitory meaning over a 12-month period, and they're beginning to accelerate their tightening of monetary policy, and that means higher interest rates. Of course, everyone in the industry understands that the building material system right now is a real challenge. We do think those supply chain obstacles are going to persist well into 2022, if not 2023, but maybe we'll see some easing with respect to the particular supply chains in the industry. And then at the end of this deck, multifamily remodeling should continue to grow. We've got a little bit of growth for single family construction, but it looks a little bit flat on our table, but it's about 25% higher than the production levels that we saw in 2019. But the big thing, whether from a policy perspective or thinking about market dynamics, housing affordability is likely to continue to decline in 22 and 23 due to higher home prices, rising rents, and increasing interest rates, in addition to the rising inflation challenges. And that means that the ongoing great relocation or the migration effects that we see through the economy is likely to continue. And those places, those markets where it's easier to build housing, they're going to build more housing and their population is going to grow. And it's frankly, it's for that reason that more than half of U.S. home building is located in the South. So let's start with the macro environment. You can see the declines in the first quarter and second quarter of 2020. It's worth keeping in mind just how bad from an economic perspective that second quarter of 2020 was. Really just there's nothing quite like it. It was just a sudden stop for the economy, a pretty strong rebound in the third quarter. And there's some debate among economists on whether we experienced a K-shaped recovery, meaning some people did better and some people did worse, or a V-shaped recovery. I would argue, putting the politics aside, that this was about a V-shaped recovery as you can get. And you can see the decline in the second quarter, and then that really strong rebound in the third quarter. And, look at the data back 20 years. You really just never see that kind of impact. Growth has been pretty strong since then, with the exception of the third quarter of 2021. And that's that blue bar right before that vertical red line. Growth came in at only a 2% annualized growth rate. Delta, combined with supply chain issues and rising inflation, were undoubtedly behind that miss. We had it at about a 4% growth rate, so it only came in at half of our forecast. We thought we were already being a little bit more negative. We think there'll be a bounce back in the fourth quarter, but the more important numbers really look at the yearly numbers there in the box. About a 4% growth rate in 2022. And then by time we get to 2023, growth continues to slow. And we're beginning to approach just about a 2.5%. We've got 2.8 on here on the table, but roughly a 2.5% growth rate. And when you get down to that speed, the economy begins to begin to pick up non-zero recession risk. So if you're starting to think about when's the next kind of cyclical based downturn, it's starting to look like the risks, I'm not saying we're having one, but the risks begin to pick up in 2024, which is a presidential election year. So it's going to make the politics and the elections that much more complicated, particularly for the Biden administration going forward. Now, it's important to keep in mind that almost 6% growth rate for 2021, that's the best year for economic growth since 1984, which is an incredible statistic. But it's a bit of a cheat. Now, I don't mean cheat in kind of a negative way, but a lot of the growth in 2021 is due to a massive amount of government spending that was pushed in the economy. This is a graphic here indicating the levels of federal government spending. If you go back to 2008, there's a little bit of an uptick there. That's the American Recovery and Reinvestment Act, which at the time was just under $1 trillion and was one of the largest bills that Congress had ever passed. It is swamped by the multiple pieces of legislation that were passed for stimulus and household checks and expanded unemployment insurance benefits and loans to businesses and government, state and local government assistance. And you can see just the dramatic increase in government spending. Now that's having two impacts, particularly when we think about the housing market on the overall economy. One, there's a lot more money out there, so it's not a big surprise that home prices and rents have increased and that the demand for housing has gone up. But that amount of money, I think most of you would agree, is inflationary. And so that's the reason that we're seeing a really strong pickup in inflation pressures. And as we've said, from a policy perspective, any additional big government spending programs, whether it's for the military or for schools or for infrastructure, even places where there's bipartisan agreement where we need government spending, it's going to have to be paid for at this point. You can't do it with the deficit. And there's only two ways to pay for government spending: higher taxes or inflation. And thinking about the government's balance sheet, the blue line here is debt held by the public as a percent of GDP. Before the COVID crisis, it was right around 75% debt to GDP ratios. That wasn't too bad. It's been better. You can see back in 2006, it was actually about 35%. But it has now gotten up to about 100% debt to GDP ratios. And so that's having an impact on inflation. And higher inflation means higher nominal interest rates. So it is going to have an impact on the cost of capital and an impact on the cost of buying a home. The other factor within the kind of the broader macro picture is the fact that the labor market has not fully recovered. Now, the red line on this slide is the unemployment rate. It peaked at around 15% back in the spring of 2020. That was better than we were forecasting. We were concerned we'd see an unemployment rate get closer to actually 20%. There's some argument that maybe we didn't measure it correctly given some changes in the economy, but that's the official rate. And then it's come down fairly quickly, another sort of evidence of a V-shaped recovery due to all the government action. But right now, we think it's going to stay below 5%. And in fact, it's going to go below 4% as we get into 2022. Now, on the flip side of that declining unemployment rate has resulted in what you see in the blue line, a rising rate of open jobs. And this is an incredible statistic, but right now there are more than 11 million open jobs. You could literally take every person on unemployment, put them into a job, and there would still be open jobs in the United States right now. And it's a consequence of diminishing immigration and the fact that we've got a lot more workers on the sidelines. So filling these open jobs actually is a real key policy challenge, and it's got to be part of the story of fighting inflation. We have to address all these open jobs. And as I said, there's a lot more workers on the sideline. You can see the labor force participation rate as evidence of that. Before the COVID recession, we were at a 63% participation rate. That's the share of working age adults who either hold a job or looking for a job. It fell down to 60%. There was a bit of a recovery during the second half of 2020, and right now it's about 62%. And it doesn't sound like a big gap, but that 1 percentage point decline that's still essentially baked into the cake does represent at least 1 million workers who have moved to the sidelines. And I'll show you later the impact that is having on the construction industry as well as other industries in terms of the skilled labor shortage. Another factor, and we like to sometimes kind of pull back the economic data lens. This is data going back to 1948. So, right after World War II. If we're thinking about the fact that we have this growing labor shortage in construction, in manufacturing, transportation, energy, frankly, sectors of the economy that have traditionally recruited more men, you can look at what's happened to the labor force participation rate in the United States during the post-World War II era, and it's been a steady decline. Now, some of that is the aging of the population, so there's more retired people, but there are other challenges in there. I would throw out opioids. You've got a larger share of young adults who live with their parents, so the urge to go out and work is somewhat diminished. But falling from 86% to 62% is a really dramatic decline over a multi-decade period, and it's a real policy challenge. And of course, one the industry is trying to address itself with energy and resources and money to try to recruit people into the construction sector. And just to kind of bring the symmetry, here's the labor force participation rate for women. Looks a lot different. It's growing during the 50s, 60s, and 70s. Admittedly, it did level off in the 90s and has declined a little bit, but it's a totally different picture than what we see from the male labor force participation rate. And as I said before, that means disproportionate impacts on sectors that have traditionally recruited more men than women, which is something we've got to fix in the construction industry. All right, so we talked about the labor challenge. Here's the inflation challenge. Now, this is the core PCE. This is not the CPI. This is a kind of a broader measure. It tends to be lower, and it's the one the Federal Reserve uses for monetary policy. Before 2020, it was averaging about 1.8% growth per year. The Fed's target was to keep it below 2%, and it actually was coming in a little bit low. The Fed wanted, and this sounds amazing now, but the Fed actually wanted to find ways to increase inflation a little bit. Well, we got it now. So they're not trying to increase inflation, and you can see that red line spiking. We do think we're probably near the peak of some of those inflation pressures, and they're going to ease. But you can see everything after that red vertical line is our forecast. You know, we're looking at almost 3% average inflation on this core PCE measure, so something higher on CPI, for the next 2 to 3 years. So we did not buy into the transitory talk. We do think some of these challenges will improve, but we're basically moving into a higher inflationary environment, and that's going to stick with us for the next couple of years. The other thing that can keep in mind is the housing cause and effect on inflation. These are two different measures of inflation. The red one is kind of a made-up one. It's called imputed rent. It's the rent that as a homeowner you pay yourself. It's more of an economic analyst type data point. But if you look at the blue one, that's the rent of primary residences. And right now, it's actually right around 3% on the inflation component. Now, housing inflation is about 1/3 of total inflation. I don't think anyone out there believes right now that rents are only increasing by 3%. So this is a lagging measure. And in terms of going forward, future inflation measures, this is going to go up. So this is going to keep pressure on higher inflation, at least in terms of the data itself. And there's another reason that this is going to have a lagging, persistent effect. This data is only reflected in rents as leases are signed. So in other words, if the actual prevailing rent is increased, but you're under a lease for the next 9 months under a lower rent, that higher rent that would get charged with your new lease won't show up in the data for 9 months. So this effect is going to grow more powerful, and what we're going to see is a lagging contributor to the inflation data from housing itself. And of course, we know the reasons that home prices and rents are going up. We have a housing deficit. How big it is open to some dispute, and I'm happy to kind of take some questions later in Q&A in the various sizes of the housing deficit. But without a doubt, that red line and the blue line are going to move higher in 2022 and 2023. Now, if you're looking for more of a dovish commentary, because most of what I've said has been fairly hawkish in terms of inflation, you look in the bond market. There are these securities that are indexed to inflation, and they give us kind of a sense of where Wall Street and bond buyers think inflation is going to be 5 to 10 years down the road. And right now it's right around 2.5%. And that's kind of where it should be. So the bond market right now seems to be saying, yes, we've got an inflation problem in the short run. It is going to kind of fix itself over the, say, the next 5 to 7 years. When I go around giving the talks around the country, I will tell you that a significant, it's a minority, but a significant number of builders don't believe and basically think the bond market right now is underestimating some of those inflation pressures. And as I said, later today, we're going to get the Federal Reserve announcement. Our forecast has to be built around, a forecast of what the Federal Reserve is going to do. They're tapering right now their bond purchases. Since the COVID crisis hit, they've been buying mortgage-backed securities and treasuries to keep long-term interest rates down. So diminishing that will end no later than spring of next year. But the big thing is, when will they begin to raise interest rates, the federal funds rate that they target? We think that we'll get at least 2 rate hikes in 2022 due to the higher inflation that I showed you earlier. And the first one is likely coming sometime before mid-year, with maybe a second and a third during the second half of 2022. And then, if you look at market expectations, it looks like markets are expecting 3 to 4 additional rate hikes in 2023. And I would say that's all based on the assumption that the economy continues to grow. If it slows because of those higher interest rates, the Fed might have to pull back a little bit on those expectations. We'll get more word from the Federal Reserve itself later today. So if we plug that in, all the macro data we walked through, keeping in mind some of the issues with the virus, here's our interest rate outlook. The most important one, of course, is the 30-year fixed rate mortgage, the red line. You can see, over the course of 2021, it's gone up and down, kind of trended just ever so slightly higher. The 10-year Treasury today is actually at 1.4%, which is relatively low compared to where it's been recently. But the red line, the 30-year fixed rate mortgage, we do think is going to trend higher over the next 2 years. And what we think is kind of the important level to watch for housing demand is when it begins to approach an average 4% rate. Right now, according to Freddie Mac, it's right around 3.1%. So that's only 90 basis points away. And if you kind of assume this kind of, the noise in the data, a little bit of up and down on interest rates, we've got us reaching a 4% rate in the United States on the 30-year fixed rate mortgage about the middle of 2023. There are definitely forecasts that have that moment occurring a lot more quickly. The Mortgage Bankers Association think, for example, we will see a 4% rate in the middle of next year, 2022, so only about 6 months away. I think that's probably a little too aggressive, and I've been guilty in my forecast, just thinking about mistakes we've made in the forecast in the past. I've typically gotten interest rates too high in my forecast. So we're pretty comfortable with the 2023 outlook. And why does a 4% rate matter? Well, if you look back in the data in 2018, you can kind of see a little bit of a hill. That was the peak rate of interest as the Federal Reserve was tightening back in 2017 and 2018. And back then it peaked at about 4.9%. And that was a rate high enough to really slow down home sales and single family construction. The market went sideways for about 6 or 7 months, kind of like it did in 2013 when you had a quick jump in interest rates due to what was back then was called the taper tantrum. Well, we don't think the market needs to get up to a 5% interest rate today to slow the housing market because home prices are a lot higher. In fact, in the resale market over the last 2 years, they're up more than 30%. So if you kind of run the numbers, it suggests about a 4% rate is kind of that speed bump level where you would see some slowing of market activities. So keep that in mind when we get to the forecast section. A lot of our projections are based off of those interest rates. And as I said at the beginning, housing affordability is going to continue to decline. Every organization has got some measure of housing affordability. This is ours. We do it with Wells Fargo. It's called the Housing Opportunity Index, the HOI. It's basically the percent of new and existing home sales that are affordable for a household right in the middle of the income distribution. And back in 2012, about 8 out of 10 home sales were affordable for that middle income buyer. It's trended lower over the last 10 years because of underbuilding, and then it's really taken a dip down in 2021 due to all that home price growth. So if you're thinking about where this index will go in the future, higher home prices, albeit slower price growth, but we do think home prices are going to continue to grow, and higher interest rates means that this index is going to weaken. And as I said at the very start, that is one of our concerns with the market is declining housing affordability. All right, so if you go out and you talk to builders, remodelers, everyone else in the residential construction industry, they will tell you certainly for the last 2 years, but really more broadly going back to 2014, the market has been supply side constrained. And I've kind of referred to these limiting factors as the 5 L's. It's a lack of labor, a lack of land and lots, lending to private builders. We've got issues with laws and regulatory burdens that make building more expensive. And of course, over the last 18 months, lumber and building materials have been a big impact. Some condo developers tell me I need to add a 6th L, which is litigation, which has caused condo development to really be transformed more into the for rent space. But those limiting factors are things that we've tracked. And here's the overall measure of where residential construction costs are. This is from the producer price index data. So this is wholesale prices that are used as an inflation measure. And we create a basket of typical goods that are used in residential construction. And yes, some goods are more expensive than others in terms of their changes, but in aggregate and weighted by how much are used, right now those construction costs look like they're about 19% higher year over year. And you can see, look, a real strong uptick in 2020 and 2021 in terms of those costs of construction. And of course, the poster boy for this has been the lumber market. If you look at lumber prices, they were at $350 per thousand board feet back in April 2020, shot up, came down a little bit near the end of the year, and then at the start of 2021 really went up to about $1,500 per thousand board feet. All in, adding $30,000 or more to a typical single family home and about $10,000 to a typical apartment. Prices then did come down mid-year. Some of that was with a temporary increase in lumber production, but a lot of it had to do with builders pulling back, and there had been some panic buying, some hoarding. That has been pulled back. And then you can see what's happened over the last couple of months. Pricing has gone back up. And in fact, right now, the real-time price is about $700 per thousand board feet. And the futures market is suggesting it can easily get up to $800-900 in the coming months. There's been another factor that has caused some of the volatility, and that's lumber tariffs. The tariff on Canadian lumber, and about a third of the US's lumber supplies come from Canada. That tariff is set to double from 9% to almost 19%. We're hopeful that maybe in January and February, with some advocacy efforts, that maybe those lumber rates will come down, but those tariffs are making lumber more expensive and are responsible for the volatility that you see in this particular input market. As I said at the beginning, I think as some of the supply chain issues heal, what we're going to see in 22 and 2023 is that once again, the top supply side headwind for the building industry is going to be the skilled labor shortage. And in fact, in October, which is the most recent data we have, there were more than 410,000 open positions in the overall construction industry. And that is an all-time high, highest measure ever recorded for the construction industry. The red line here is basically an intensity measure of how bad the labor shortage is. And you can see it was going down in 2020. Well, there was a reason for that. We had higher unemployment, so there were more unemployed people to recruit from, and the non-residential construction sector was weaker. So builders and remodelers were able to essentially take workers from the non-residential sector. That has now ended. That red line is going back up, and the skilled labor challenge is going to be with us certainly over the next 5 to 10 years. And economics 101, if you've got a labor shortage, what's the impact going to be in the overall market? Well, wages in residential construction are increasing. In fact, if you look at this slide, right now they're 8% higher year over year. It kind of went down in 2020. Some of that was due to the COVID effect and some declines in activity, particularly in the spring. But if you kind of eyeball this from 2011 to where we are now, basically the growth rate for residential construction wages has been trending higher over the last decade. And unfortunately, I do think that's going to continue. The only bit of good news is that higher wages will help recruit additional workers. But those higher wages really need to be backed up by improvements in productivity, more output per worker in the sector. And that's the only way that we can get sustainable wage growth over the long run. I'm not going to go through all the numbers on this slide. You can kind of just read through them, but there's one number I want to point out that's underlined there in the second bullet point, which is that the construction industry needs to be adding about 740,000 workers per year to account for industry growth. And then more importantly, what we call occupational openings, replacements for workers who are retiring. Because the median age of a construction worker in the US right now is 41. We've got a large number of workers in their late 50s, some even in the early 60s. They're going to be retiring, and we're going to have to replace those workers with a new generation. And so 740,000 workers is quite an uphill challenge. And keep in mind, for every single family home that we build, we need about 1.7 construction workers. So if you're talking about millions of homes that need to be built, you got to make sure that you've got a construction workforce. Right now, it's 3.1 million in residential construction, including remodelers. And this is a real challenge. And so there's organizations like the Home Builders Institute that are out there trying to train tens of thousands of workers, so they're available for the industry. I mentioned lumber, I mentioned labor. Let's just mention one of the other L's. This is lot shortages. There's a lot of data on lots out there at the local level. NAHB once a year does a survey looking at lot supplies nationwide. And this survey goes back 24 years. And the reading that we took in October indicated it was the worst lot shortage we have in the history of the index. Almost 80% of single family builders said lot supplies were low or very low, which roughly means less than about a year of available buildable lots in their markets, available in those individual markets. So typically this moves with housing starts. You can see since 2012, we've just been constrained by lots much more than the takeoff in actual single family construction activity, which is in blue. And this is going to be an ongoing challenge. I think we all know it takes about 2 to 3 years for raw dirt to be turned into ready to build on lots. And a lot of this is zoning law challenges and other kinds of policy obstacles to get more lots into the system. All right, so we took a look at macro. That was a kind of an update on the supply side. Well, if we put this all together and take a look at the construction industry, and I thought I'd start with remodeling. We often sort of put remodeling in third place, so let's move it up forward. This is our quarterly remodeling sentiment indicator. It's the NAHB Royal Building Products RMI. It's actually an all-time high right now. It's at a level of 87. It's a 0 to 100 point score. Anything above 50 indicates positive market territory. And we build it to roughly track with the level of residential improvement spending, one type of measure for the remodeling industry. And so what it's suggesting right now is ongoing growth for remodeling activity. And in fact, based off the fact that costs of construction are higher, as we just walked through, we did ask remodelers in our survey, have they raised their prices in the last 6 months? And 85% indicated that they have. So the price of remodeling, just like the price of new homes, has gone up. And we further asked that 85%, if you did raise your prices, did it price out demand? And it was really striking. Economists, you would expect higher prices is going to price out demand. 50% indicated that no, they were able to actually have real pricing power. Were able to raise those prices. And so higher costs of construction, yes, but pricing power there in the home improvement industry. So here's our remodeling forecast. Every group measures this a little bit differently, by the way. Harvard's Joint Center has the leading indicators of remodeling activity. We use a measure of remodeling activity that comes out of the GDP accounts, but regardless, in 2021, we think that data set will show about a 13% gain in remodeling activity. And in 2022, we still got growth. We think it's going to slow a little bit because existing home sales are going to slow with higher interest rates, but we're still going to post about a 6% growth rate for the overall remodeling industry. And then if we turn to single family, this is the NAHB Wells Fargo Housing Market Index. It's our monthly builder confidence measure. It came out today. So I've got on the slide a level of 83. It actually ticked up in December to a level of 84 with today's analysis. And again, we create the HMI so it moves along with single family starts. There's a lot of noise in that data set, but if you look at the red line, it had been trending lower in 2021. We kind of got into an unsustainable level of activity at the end of 2020. So some market cooling in single family construction. But what the HMI is now telling us is that we can expect some growth off of that cooling trend. So if you take everything I've walked you through, the supply side, interest rates, the GDP outlook, the labor market outlook, here's our outlook for single family construction. As I said before, I do think it's more conservative than others, but we typically try to plan for things to go wrong into the forecast. So for 2021, we're going to end the year a little under 1.1 million. About a 9% growth rate. And then looking forward, we got a little bit of growth. It says 1%. It'll feel a little bit flat, but a little higher than 1.1 million single family starts for next year. But the important thing to keep in mind is that 1.1 million rate is about 25% higher than the 2019 rate. In fact, if you look at the blue line, you can kind of see the trend that we've been through. from 2011 up through 2019, there's kind of a linear growth trend as we add workers and the available lot pipeline expands and the rest of those limiting factors expand to allow for some additional growth. In 2020, we saw a dip due to COVID, a strong rebound that made up essentially for lost time. It got too hot, it cooled off, just like I showed you on the HMI slide. And now it's come back to the kind of, if you eyeball it, the long run trend line. You kind of draw a line through the 2011 through now. And that's kind of where we've got it going in terms of overall volume of activity. So 2023, again, we're looking for a little bit more than 1.1 million. I just don't see the available construction workers, the risks with higher interest rates pushing us up much higher than, say, that 1.1 million, certainly no higher than 1.2 million over the next couple of years. And I'll tell you, in some of our surveys, some builders do expect some market declines in some local markets because housing affordability has gotten out of whack with local incomes. The geography story, we could do a whole webinar on geography, but one of the stories in 2020 was something we were calling the suburban shift. Single family home construction as well as apartment construction was growing faster in low density markets. And that's closed up a little bit. That suburban shift eased in 2021. And just as proof of that, all the counties in blue you're looking at are inner suburbs. They're core counties of large metros that have more than 1 million population. And those blue counties as a group represent about 17% of home building. And over the last 4 quarters, they've been growing at a 21% annualized growth rate. Now, if we look at some lower density markets, these counties in red, this is actually a bigger building market than the prior slide. This represents 29% of single family home building. And the growth rate is a little bit higher, but not a lot. It's a 24% growth rate. So what we saw in 2021 is growth just about everywhere in the country. The shift, the real kind of movement out to the exurbs was really a second half of 2020 story, and it has now eased. And I'll say there were a lot of people in 2020 that denied that shift in demand had taken place. They seem to have now caught up with the story, but I think they're still behind the curve because we see in both the apartment data and the single family data, the demand is moving back to some of these medium density locations. And in fact, in the second quarter of 2021, we had the best quarter in 14 years for townhouse construction. And that typically occurs in medium density locations. One other thing before we kind of move over to the multifamily market to wrap up, for the last 8 years, we've consistently in the United States had more apartment units under construction in the construction pipeline than single family homes. You can see that red line from 2013 to 2021, the red line was above the blue. So more multifamily units under construction. That reversed roughly in August. So for the first time in 8 years, we now have more single family homes in the construction pipeline. There's a couple of reasons for this. One, there was the acceleration in single family starts during the second half of 2020, unsustainable in my opinion, but that acceleration means more homes in the pipeline. And then more importantly, cycle times have gone up. And then in our surveys, we hear builders saying it's taking 4 to 8 weeks longer to build a single family home. Typical build time in the data is about 7 months. And there's reports of even longer extensions due to delivery delays in materials, the availability of workers and the like. So not a big surprise that blue line has gotten essentially caught up with the red, but it is kind of an important moment after about 8 years where it was really multifamily that was leading the construction side. A market that has gotten a lot of attention, it's kind of a good bridge between single family and multifamily, is single family built for rent. We can talk about this more detail in Q&A, but we think this market is growing. And in fact, in the third quarter of 2021, we have the highest level of single family units built for rental purposes in the history of the data that we track. And I think that kind of growth is going to continue in this market because declining housing affordability. People want space, they want a single family structure, but not everyone can afford the down payment of that home. And then lastly, the multifamily market, we have actually revised this up. We were, a year ago thinking we would see some ongoing weakness in multifamily, but I think the reopening of the economy, declining vacancy rates, really strong rent growth 10 to 20%, depending on individual markets, is supporting apartment construction. This year, it's going to be up 19%. We've got a growing 6% and getting real close to about 500,000 units started next year. It's worth noting 95% of this is built for rent. Historically, that share was only 80%, so there's a lot more built for rent. And then the geography of this has changed as well. There's a lot more suburban multifamily development, and we think that's going to continue over the next couple of years due to hybrid work models, work from home and the like. They're going to give people a little bit more room from which to pick not only rental multifamily, but also for sale single family. So with that, that's our economic and housing outlook. My email address and Twitter account are available on the screen, and almost all the data that we walk through is available on our economics blog, which is eyeonhousing.org. And with that, I'm going to stop sharing my screen and happy to turn it over to Jennifer. Maybe we can do some questions.
Yeah, absolutely. Thank you so much, Rob. That was a great presentation. So much information. And today's a really exciting day for you. So tell us a little bit more about what might happen this afternoon and how that will impact everybody on the call.
Yeah, so I guess it says more about my life that the Federal Reserve announcement days are exciting days for me, but they are. I mean, so, I think we're going to get word about, what the Federal Reserve is going to do. As I said before, Chairman Powell has retired the word transitory when it comes to inflation. Our concern, kind of as housing cheerleaders, and we'll admit that, we're sort of biased in favor of the residential construction industry. We don't want the Federal Reserve to move too fast. Yes, we think inflation is a challenge, but if they give word today that they're going to really speed up the taper, that they're really going to move forward some of these expected interest rate hikes, that means higher interest rates for home buyers sooner in 2022. So I kind of put that flag out in the field. I'm saying that 4% rate is where we need to look to be concerned about housing demand. I'm going to stick with that next year. I know a lot of builders who say, we can deal with a 4% rate, but I think maybe they're being a little too optimistic. So we're going to watch what the Fed says. And I'll just say on behalf of the NAHB advocacy team and other different part of the shop at our trade association, but we do take the NAHB leaders, builder leaders of the association, to meet with the Fed every year. That meeting will be in June of next year, which is really well placed because that's when we think they will begin ramping up interest rates, and we'll want to make sure that we deliver the story of what that impact is going to be on the overall residential construction industry.
Sure, it could be it could have a really strong impact. So we'll be watching for that. So one of the things that you and I were talking about before was panelization and prefabrication. So how do you see that coming into the industry? How do you see it impacting the industry, creating efficiencies, that type of thing?
Yeah, so let's take a step back. We've got a labor shortage. One argument that's been made by many in the industry is if we do more construction off-site in the factory, we can take advantage of economies of scale, and that will help address the labor shortage. Now, to be clear, the reason we walk through 5 or 6 L's, there's no silver bullets in the underproduction of apartments and single-family homes, and I don't see off-site construction as a silver bullet, but every little bit helps. And so maybe the ability to get some productivity gains in the sector through use of off-site construction will help. And it's probably worth some definitions. When we talk about modular, we're talking about most of the home built in the factory, with 3D built type homes. When we talk panelized, we're talking about building the frames in the factory and then assembling those frames at the work site. You've got emerging things like 3D printing, which is really concrete frame type housing. And then you've got manufactured housing. Now that's a separate bundle. Manufactured housing is really more, we would have called them mobile homes years ago. That's about 100,000 units a year. We think we'll get a little bit of growth. But if we take modular and panelized together, it's only about 3% of single family starts. Now, the reason that number is important was if you look at the late 1990s, that market share was 7 to 8% of housing starts. So there's a need for it to grow. There's a room for it to grow, and there's historical precedent. And my forecast is that we are going to see gains in that kind of housing. I don't think it's going to become like a quarter of home construction, but I think it can easily get up to 10%. And there's a lot of capital flowing into, big builders working with these kinds of investments, working with startup companies. And I think there's a lot of potential for growth in the industry. And that's one of the ways that we can get some productivity gains. So no silver bullets. We got to curb our enthusiasm on the ability of some of this stuff to help. But 2022 and 2023 are going to be years of housing innovation. And we're going to see improvements like in that space.
Oh, I'm so excited to see it. We've got to. I mean, we've got to be, to meet demand and then resiliency. So one of the things when we talk about modular, when we talk about prefab, one of the things that pops in my mind is how building code is accepting those things. So I'd like you to respond to that, but then that also leads me into how building code is going to be impacting us in the way of thinking about climate change and resiliency and those types of things. So could you just talk about building code in general?
Yeah, so let's think about building codes and maybe zoning codes too. So we certainly need improvements in zoning codes. That's the one way we're going to be able to build with density to get some of that additional housing supply. It's ways that we'll get some of these innovative construction techniques and types of housing in the certain neighborhoods. But yeah, if we kind of narrow down to building codes, look, there are some challenges and opportunities in this space. Now, the challenges are clear that every time we see a ramp up in building codes, the cost of construction absolutely goes up. And you can make the argument that some of those improvements are not things that the market otherwise would ordinarily accept. So that is a political process. But I will warn builders, we are going to face an increasingly costly code environment as we move forward for exactly the reasons that you indicated, Jennifer, whether it's growth in the need for resiliency from policymakers, climate change, wherever you stand on it, is going to be a huge topic of where we build, how we build. And I'm not saying that all this kind of policy is good. I have strong disagreements with some. My biggest disagreement, just as an example, I think it's really foolish to put all the code requirements on new construction. The low-hanging fruit, and here's where the opportunity comes in, the low-hanging fruit when it comes to codes is the existing housing stock. It's not energy efficient. It's not particularly resilient. It's aging. So, I think if policymakers are going to force builders to bear the entire burden of some of these policy issues, we got to open the conversation about what we do with the existing stock. And if there are requirements placed on the existing stock, that is a real business opportunity for remodelers and home builders. And we estimate in a given year about 6 to 7% of single family starts are teardowns. I think that share is going up regardless. And if we see improvements required of the existing stock, that share will go up as well.
That's heartbreaking. Too bad we can't fix that property that's already there. So I did say, I saw some of your stats about infill properties too. So I think that's uplifting. And hopefully we can find more of those opportunities because there's just so much demand. Anybody who has questions can enter them anytime on the chat feature, but I have a few more questions. What do you think in terms of technology and how technology can help builders get to that point? They have so many responsibilities. I mean, builders have to be looking, experts on the zoning, on the building codes, on resiliency, on net zero, or however the sustainability requirements that are evolving in each area. So what is NAHB doing, or what kind of technologies do you see that are out there that builders can put their hands on that help them through that process?
Yeah, I mean, just the length of requirements and hurdles you have to jump through to develop land, to build homes, apply for remodeling permits. It does make you wonder why anyone bothers at the end of the day. I think from an aggregate perspective, yes, builders have to be jack of all trades, without a doubt. Look, from an industry perspective, we can speak with one voice. I would encourage all of you, if you're not members of your local building association or small business associations, join, make your voice heard on some of these issues, because a lot of these issues, they're not decided at HUD. They're not decided by the administration. They're decided at the local level, and really it's speaking with one voice. The other argument, though, is we have to be champions of housing affordability. And so there's multiple ways to do that. It's making sure we have an available rental housing stock so that young households have a place to live where you can afford and to save and accumulate a down payment to be able to buy a home. And then we have to sift through those policy rules that we find ineffective. And I'll give you two examples of regulatory rules I think add cost and hurt housing supply. One of it is green space requirements. And I'm not saying green spaces don't have value to a neighborhood, but when you dedicate a certain amount of land to be unbuilt, there's a cost to that. And local communities often don't pay that cost, but it goes into all the other homes that you build. And so, when I talk to mayors and zoning officials across the country, they'll make two complaints of me. One, they want to regulate the market, and two, they ask, well, where's all the entry level housing? And so those two things are often in conflict. The other example, though, is parking requirements in multifamily housing. We should be building apartments, not parking spaces. And so if we can reduce some of those kinds of things in anticipation of, more Uber, ultimately maybe 10 or 15 years, self-driving cars and the like, we can build more housing and less of this other stuff that just makes housing more expensive.
Sure. Yeah, no, those are great points. So we have a question from Rimbus Maddie. What would be your short and midterm forecast for new single family homes in the $2 to $3 million market?
Yeah, so that's actually a harder market to track. It's a market that probably should overperform the overall marketplace, because if you look at my more conservative forecast, it's based off of higher interest rates. Now, what do we know about the marketplace of homes that are $1 million or $2 million or more? They tend to have much larger down payments. They tend to come from older, wealthier home buyers. It's more of a custom market, and they're less sensitive to changes in interest rate policy. So it depends on the local market conditions, obviously, and that's why you always want to work with a local data consultant. But at the same time, if there's one place where there's a little bit more competition over the next 5 years or so in the housing space, and we know most of the market suffers from a lack of inventory, it is going to be that higher end custom type building. There's going to be more competition, particularly as some of the baby boomers retire. So that's a kind of a tailwind and a headwind, but I think overall that kind of really high end market will overperform the overall market. You just got to be careful. Are we talking 2 to 3 million homes in a growing high cost metro area? Are we talking $2 to $3 million homes in a rural market where there's not a lot of demand? So it can differ a lot geographically.
I've seen a couple headlines recently about how second homes are trending upwards. Does that hit that niche to $2 to $3 million homes, or what's happening in the second home market?
Yeah, so absolutely, that can include that second home market, particularly for that wealthier buyer, and the overall second home market. We do a kind of a geography index, kind of like the maps that I showed you before. And what we found was that communities with large concentration of second homes, new homes, so this isn't just vacation homes, but those communities, they were growing at about a 22% growth rate year over year just recently. So second home markets have definitely been hot. I think that will continue even as interest rates increase. And a lot of it has to do with demographics. You got a lot of younger baby boomers, high wealth. The stock market has done particularly well over the last 2 years. So they're going to look for places to make those investments. You could continue to have people looking at staycations. We've seen a lot of investment in remodeling, in new construction, and exterior amenities. And of course, a vacation home in a nice location is the ultimate way to invest in amenities. And then work from home. It's not a huge market. We're not talking about kind of workforce housing, but there are a fair number of people who choose to invest in a second home because they don't have to commute to the office constantly. And I think that kind of trend is going to continue.
Thank you so much, Rob. We're out of time now, and I appreciate everybody who joined us. If you have additional questions, you can reach out, but we at Build Exact are honored to have you share your insights with our audience. Rob, thank you so much for your time. And then we also at Build Exact would love to connect with everybody who attended to show you how we can help and we can really grab onto those opportunities that Rob just outlined, because there are a lot of opportunities out there. So it's an exciting time for housing and we're glad to be part of it. So thanks again, Rob. And thanks everybody for joining us.
Thank you all.
Bye.